Good day, you are welcome to my channel. This is Kevin Davis Accounting. So today I would like us to do a last part on dissolution. Of partnerships. Now this time, as we are looking at dissolution of partnerships, I want to put an emphasis where we have some partners who are insolvent. Now sometimes when you're dissolving the partnerships, one of the partners or two of the partners could be insolvent. What do I mean by a partner being insolvent? It means the debit side of the capital account is heavier than the credit side. For example, I assume that we have partner A and partner B like this. So we have partner A and partner B. This is the capital account. So I assume that we are dissolving the partnership. Maybe we have a balance brought forward this side. We have 10,000 and then 6,000, and maybe we have a current account here, current account balances. Now I assume that one of the partners has a normal credit balance, and then partner B will have this side as 5,000. So I assume we have 5,000 like this, and then maybe there was a loss on realization when they sold the assets they had, and they got a loss on realization. So it's a loss on realization. So loss on realization, maybe I assume that these are equal partners sharing profits and losses equally. So that means I assume that this one has 3,000 and this one 3,000 as well. So this could be the capital account. And so once you close up this capital account, you realize that for partner A, once you compare the debit side against the credit side, you have 14,000 here and then 14,000 here. That means you're going to pay this partner through the bank an amount of 11,000 like this. But then this is not the case when it comes to partner B. Partner B, the debit side is actually outweighing the credit. So we have 8,000 this side and then 8,000 this side, meaning that this partner has overdrawn his account. Now, once the partner overdraws his account, it means it's the partnership now that is demanding him. That's why the amount of money that he has in his account is less than that which we demand him. So because of that, this partner B becomes an insolvent partner. So an insolvent partner, this is the partner whose debit side of the capital account outweighs the credit side of the capital account. So the thing is that once this partner is insolvent, what this partner has to do, he has to go and pay this money. So he picks money from his own pockets or from his savings, then he comes and pays the partnership. So meaning, for example, this partner here, we have 8,000, this side, 8,000 this side. So meaning there is a deficiency of 2,000. So meaning that this partner is going to have to pay, he has to pay us the 2,000 here to the bank. That means once he pays us to the bank, the double entry will be debit bank and then credit capital account. So meaning that you're going to say debit bank, credit capital account. So if it's 2,000, you're going to bring 2,000 here and then you're going to call it bank. So this means that once you do this, the debit side of partner B and the credit side of partner B will be the same. So that's how we deal with the partner who's insolvent. Now, this could be one of the ways through which we deal with insolvent partners. But then also, you might find that a partner, some partners can only bring half of the deficiency. For example, if this partner B could only bring in 1,000, it means the other 1,000 he was unable to bring it in. Now, when it comes to such a scenario whereby a partner can only bring in half of his deficiency, or if a partner cannot bring in his deficiency at all, then we are going to apply the rule of Ghana versus Murray. Okay, so this is what we are going to apply. Now, the rule of Ghana versus Murray is simply that the partners who are solvent, they are going to combine and then pay the deficiency of the partner who is insolvent. I'm trying to say that if you find out that there are partners who are solvent, these partners who are solvent, they are going to combine and then pay out. They're going to pay out the deficiency of the other partner who's insolvent. For example, in this scenario here, if you see, in this scenario, for this person now, I assume it is still like this. Now, this partner is insolvent because his credit side is 14,000, the debit side is 3,000, meaning he's supposed to receive 11,000. But then you find out that for partner B now, he's insolvent. He has only 6,000 this side and 8,000 this side, meaning that this partner is supposed to pay the 2,000 from his own pockets. Now, the question could say that maybe partner B could only bring half of his deficiency. So what is his deficiency? His deficiency is 8,000, which is 5 plus 3, 8, and then minus 6,000. So his deficiency is 2,000. Now, if the deficiency is 2,000, and then the question tells us that he can only bring half of his deficiency, it means we're demanding him 2,000 as the partnership. But then this partner cannot pay the full 2,000. So it means this partner is going to pay us 1,000. Now that 1,000, like I said, the double entry could be debit, bank account to show a receipt of money to the bank, and then I'm going to credit the partner's capital account. So meaning, after me crediting this, I'm going to get a half. Now, it is a half times the deficiency, which is 2,000, which is going to give us 1,000. So meaning that this partner could only bring in 1,000. So when he brings in 1,000, I'm going to come here and say current account. Then here I say bank 1,000. So it means that he's bringing in 1,000 to the bank. Okay. Now the other 1,000 which is remaining, the partnership cannot wind until this partner settles it. So it means the 1,000 which is remaining, the partner who's solvent is going to combine and pay out the one who's insolvent. Here we only have one partner. That means that one partner is going to pay for the loss of this partner. So that means you're going to say 1,000 is coming from partner A to partner B. Okay? Then this partner B is going to receive from partner A 1,000. What I'm trying to say is this, that this partner is going to lose 1,000 towards the clearing of the deficiency of partner B. So partner B had a deficiency of 1,000 after paying out the other 1,000 that he could bring in. So that means the balance now should be paid by this partner. So you come and deduct it from this partner by debiting his account, and then you come and credit partner B's account with the same figure. So meaning that here, if you check for partner B, there's 8,000 this side, then there's 8,000 this side. So meaning partner B is not going to receive anything from the partnership. And that means now that when it comes to partner A, we have 4,000 here, we have 14,000 here. It means we are going to pay him 10,000 through the bank. So that's what we do when the partner is insolvent. So allow me to rub off this, then we start a question. All right, so the question says, A, B, C, D are partners sharing profits and losses in the ratio of 2 to 1 to 1. On 31st December 2018, they decided to dissolve the partnership. The balance sheet is as follows. So they've given us a balance sheet before the dissolution. So they said non-current assets. We have plant and machinery, equipment, motor vehicle. Then we have 600 as the total non-current assets. Then we have the current assets, where we have inventory, accounts receivable, and then we have bank of 30,000. Then when it comes to the capital and liabilities, we have capital, which is A contributed 300,000, B 200,000, C 100,000, and then D 50,000. Then we have accounts payable. Accounts payable, we have a current account. So accounts payable is 100,000. Then we have a current account where we have A 100, B 150, and then C 120,000, but it's in brackets, meaning that that was a deficiency. And then we have D, which is 80,000, still in brackets, which is a deficiency. And then we have total capital and liabilities as 800,000. Then they're telling us that assets realized. Now the assets realized, we have plant and machinery at 170,000, equipment 260, and then inventory at 80,000. Then they're telling us that A took a motor vehicle of 140,000, accounts receivable realized at 70,000, and then accounts payable were paid less 2.5% discount. Realization expenses were 30,000. Now the question tells us that both C and D are insolvent. Now the question is saying that C could only bring half of his deficiency. Then that said required, prepare 1, realization account, then partners capital account, and then we have also to prepare the bank account. Then they're telling us to use, they're telling us to apply the rule of Ghana versus Mary rule. So they're saying apply Ghana versus Mary rule. So that's the question that we are going to do. So the question involves two partners who are solvent. So we have partners who are solvent too, and then the two partners are insolvent. Now they told us that we're supposed to use the rule of Ghana versus Mary. That means you're going to share now the capital contributions to those partners who are insolvent. So we begin our number. We start by drawing up our realization account. Now, I told you that from my previous video about the solution that when you're doing realization, you have to first debit all the assets to the realization account. All the assets given to you in the balance sheet. Now, here in the balance sheet, we have plant and machinery, which is at 200. So you put plant and machinery here. Is 200,000. And then we also have equipment, which is 250,000. And then we have our next is a motor vehicle of 150,000. So bring in motor vehicle. Is 150,000. Then after that, we also have inventory of 90,000. We have inventory of 90,000, and then we have our accounts receivable, which is 80,000. Like I said, the very first step should be debiting all the assets to the realization account. That's what we have done. Then if you go through the question again, they're telling us that accounts payable were paid less 2.5%. Now look at this. They're telling us that accounts payable and accounts payable in the question, they are 100,000. Then they're telling us that they are paid by 2.5% discount. Now 2.5 is the same as 5 out of 2, but then this is a percentage. So meaning 2.5% the same as 5 out of 2%. So this one you're going to get 500,000 divided by 2. Still we're supposed to apply the percentage. So if you are going to get 250,000 and then you apply the percentage, so you get 2,500. So we have 2,500 as our discount received. So I said once there's the discount received, it means you're supposed to credit realization account and then debit the accounts payable account. So it means it will look like this. This is our accounts payable. Accounts payable, our balance brought forward will be 100,000, and then we give them a discount. So the discount becomes I said we put realization discount received, which is now 2,500, which was the discount given to us. Then it means the balance that we are going to pay will be 97,500, which we are going to pay to the bank. So that's how we're going to do accounts payable. I hope that is really okay. Then they told us that these assets were realized as follows. Now, if we take it to the question, in the balance sheet they gave us bank, meaning that these assets were realized to the bank. Therefore, once these assets are being realized, I say the double entry is debit, bank, credit, realization. So we are supposed to credit them on the realization account. So we have plant and machinery here. Plant and machinery. And plant and machinery, it was realized at 170,000. So we put 170,000 here. Then we have equipment, which was at 260. It's 260,000. And then we have inventory was realized at 80,000. Now, still in the question, they told us that accounts receivable were realized at 70,000. Now, it means you're going to come here and say accounts receivable, which is 70,000. That's what we have. Then they told us that A took a motor vehicle which was valued at 140,000. Now, this is a partner taking an asset. Now, there's also a possibility whereby a partner will take an asset. Now, here, once a partner takes an asset, it means the double entry, you're not going to use bank because you're not selling it off. So, once a partner takes an asset, you're going to debit the capital account of that partner, and then you're going to credit realization. So, once a partner takes an asset, you're going to debit capital account to show a reduction of that money. Then you're going to credit realization. So once the partner does that, so we come here and we say capital, you first make the narration of the account to which you're going to post the corresponding account. Then you say partner A who took a motor vehicle, and they told us that was valued at 140,000. That's what we had. Then we also bring in our discount. So our discount is coming from our creditors as discount received, and the discount received that we are going to get was 2,500. That's what we have as a discount. Now, after this, we also have our dissolution expenses. Now, in the question, they gave us the dissolution expenses at 30,000. So it means we bring them here and we say bank realization expenses, which are 30,000. So once we are done with this, we can balance off our account. Now, when you add up the debit side, you have 800, and the debit side looks heavier than this side. So you're going to put 800,000 here, 800,000 here. So the debit side is heavier than the credit side, meaning that this partner has made a loss on realization or a loss of dissolution. Now, because of that, the difference is 77,500. That's what they are going to share between the partners. Now, it means that you're going to have partner A, you're going to say capital. Now, the difference here is 77,500. So this is the difference that they're going to share amongst themselves. So we have A, who's going to get 2 out of 5 times 77,500, which will give us 31,000. And then you're going to have partner B, who's receive 1 out of 5 times 77,500, which gives us 15,500. And then partner C, also 1 out of 5, which is also the same. And then we have partner D, receive 1 out of 5 times 77,500, which is 15,500. So this is how the realization account looks like. So this partner has made a loss on realization. So after here, I'm going to draft up the capital account. So this is the capital account. Now we begin by bringing the balances brought forward. Now the balance brought forward for A is 300. So we say balance brought forward for A is 300,000, and then for B is 200,000, and then for C it is 100,000, and then for D is 50,000. That's how we bring the balances brought forward. Then, like I said, since this is dissolution, there's no need of us maintaining the current account on its own. Therefore, can just bring the current account here. So you say current account. Now the current account for partner A, it is 100,000, which we bring here like this. Then for partner B, if you check through, it is 150,000. So you bring 150,000 here. So these partners, they had positive balances. But then when it came to partner C and partner D, their current accounts had negative balances, meaning that their opening balances are supposed to be on the debit side. Therefore, we're going to come inside and say our current account. So for partner C is actually 120,000. And then for partner D, it is 80,000. So I'm passing them this side because they put them in brackets, meaning that they had a deficiency. Their current accounts were still under demand, or they have overdrawn their accounts. That's why the balance brought forward are on the debit side. Then after that, we can bring in our loss on realization. So we say loss on realization. Now here, it is on the credit side. That's why I'm bringing to the debit side here. So that means for partner A, we take 31,000. For partner B, we take 15,500. Then for partner C, we take 15,500 as well. And then for partner D, we also take 15,500. Now, when we are done doing this, we are only supposed to close up our account and then go prepare the bank account. But now, this is the terrible thing here. If you look through partner A has 400 this side, on the credit side. That means he can pay out this loss. Partner B also has a higher figure than this side. But then when it comes to partner C and D, you realize that the debit side of their accounts are heavier than the credit side. For example, partner C has 135,500. Now, this side he has 100,000. Meaning that this partner C has a deficiency of 35,500. So if this partner has a deficiency of 35,500, it means what he has to do, he has to go into his own pocket, pick this amount of money, and then pay to the partnership. But then the question told us that this partner C can only bring in half of his deficiency. If you read back the question was saying that C and D are insolvent, but then C could only bring half of his deficiency. So meaning that this partner C has a deficiency of 35,500. Okay, because if we check, the credit side is 100, the debit side is 135,500. So meaning that there's a deficiency of 35,500. Now they're telling us that out of this 35,500, this partner C can only afford to bring half of the deficiency. So meaning, what is half the deficiency? This one's going to give us 17,750. So meaning that this partner C is going to bring in this to the bank. So it means it's going to come and pay the partnership. So the double entry here is debit, bank account, to show the receipt of money, and then I'm supposed to credit the capital account of the partner. So it means I'm going to bring this 17,750, and then I put it here like this. Then I call it bank. So it means now this figure has to appear in my bank account because this is the amount of money I'm receiving from partner C. So it means now the remaining balance, which is 17,750, is the amount of money that these two partners who are solvent, they're going to combine and pay. Okay? So it means that once the partners, these other partners who are solvent, they're supposed to combine from their capital balances and then pay the deficiency of that partner who's insolvent. Now, once we are sharing this deficiency amongst the partners are not supposed to use their profit and loss sharing ratios. The partners use the capital contributions. They don't use the profit and loss sharing ratios. So it means for partner A, the capital contribution for partner A is 300, and then that of partner B is 200. So meaning that their capital contributions, these ones here, they form the new ratio. So it means it's going to be 300,000 to 200,000. Once I reduce this, it will be 3 to 2. So they are going to share the deficiency of the partner by their capital contributions. So it means it's going to be 300 to 200, which is this. And once you reduce this, you get 3 to 2. Meaning, partner A, this is for partner A, and this is for partner B. So the total ratio is 5. So meaning partner A is going to give 3 out of 5 of the deficiency. So that means once you are calculating for partner A, we are going to say partner A is going to give 3 out of 5 times the deficiency. The question could be, how do you get the deficiency? Remember they told us that this partner could only bring half of his deficiency. The total deficiency was 35,500. So if he could only bring a half, it means the half of this is 17,750, which has brought through the bank account. Now it means the remaining half is also the same figure, which is 17,750. So it means that this partner can only bring in half of the deficiency. This is partner A. And once you get this, you're going to get 10,650. Okay? So it means now I'm supposed to reduce this amount of money from partner's that account here. So I'm going to come here and say to C. Well, I can put C account. Then partner A is going to contribute 10,650 towards the deficiency of partner C. Now, it means that partner B is actually going to contribute 2 out of 5 times 17,750. Okay? Because they are looking at sharing this loss or the deficiency. Now, this one is going to give us 7,100. So meaning that for partner B is going to contribute 7,100. So that's what I'm going to say, that partner B is going to contribute to C 7,100. That's why we are debiting them, because they're supposed to reduce their accounts. After this, because we are supposed to take this amount of money to C, it means it has to come from this side, and we say from A account. Now A is giving C 10,650. Okay, it's coming from this side to this side. So we are going to take 10,650 from A, and then this 10,650 is A's contribution towards the deficiency of C. So it means even B, we're going to say from B account, so it's bringing in 7,100. Like this. So once you add these two, the 10,650 plus the 7,100, you are going to get that difference that was missing, which is 17,750. So meaning that the deficiency of partner C has now dissolved. The deficiency is no longer there. That's how we do when it comes to sharing the deficiency of the insolvent partners. So for partner C, it is done. So if you see this side, the credit side is now equal to the debit side, meaning that partner C's account has successfully been dissolved out. Then this partner still again, after sharing the deficiency of C, they're supposed to again to share the deficiency of D, because it's also their partner, part of their partnership. So it means that for partner D, we have 95,500 this side, okay, and then we have 50,000 this side. So meaning the deficiency is going to be 45,500. Now, this is the deficiency that these partners are going to share again, partner A and partner B. So it means that from our capital contributions, we got 3 to 2, meaning partner A is going to contribute 3 out of 5 times the deficiency. Now, something strange about this partner is that right now, for the partner D, he cannot bring in anything. Rather, partner C could bring in a half of his deficiency. But then, partner D couldn't bring in anything. That means the total figure of the deficiency is what these other partners are going to share amongst themselves. So it means I'm going to pay 3 out of 5 times 45, 500, and this is going to give me 27, 200. So that's the deficiency that they're supposed to share. Then for B, it will be 2 out of 5 times 45, 500. This is going to give me 18, 200. So it means that partner A is going to contribute 27, 200 towards the deficiency of D, and then partner B will contribute 2 out of 5, which is 18, 200 towards the deficiency of D. So it means partner, we are taking to partner D. Now, I'm putting the narration here to show to whose account I'm taking this figure. So to partner D, A is going to give 27, 200, and then B will give 18, 200. So it means that I'm going to take part of my money, which is 27, 200, to D. And also, I as B, I'm going to give 18, 200 towards D. So we come this side and we say, what do you have A's account here? A is giving 10, 650 to C, but he's also going to give 27, 200 to D. Then also, B is going to give 18, 200 to D still. So we are supposed to have B account here. B is going to give 7,100 to C, but he's also going to give 18, 200. So 300, sorry. He's going to give 18, 200 to D. So it means that these partners, partner A and B, they're going to give partner D 27, 200 and 18, 300, like that. That's how they're going to share the deficiency. So that's how it's going to look like. So partner A is going to give 27, 300, partner D 18, 200, and then they're going to give them to these partners. Now, once you add up this, the credit side should be equal to the debit side of the partner D. So that's how we do insolvent partners. Now, if you add up these figures now, the credit side of partner D is equal to the debit side of partner D. The debit side of partner C is equal to the credit side of partner C. So these partners who are insolvent, at the end of the partnership, they won't take anything home because they were insolvent. Rather, they are the ones who are supposed to pay the partnership than getting anything from the partnership. So therefore, we can close up the accounts. So we realize that this side is heavier than the other side. So we have 400,000 here, and then we have 400,000 here. But then, if you still recall, one of the partners here was partner A. Partner A, they told us in the question that partner A took a motor vehicle. So that means, first to commit double entry, you credit realization, then debit the capital account for the partner. So you can say motor vehicle, which is 140,000. Now it is partner A who took the motor vehicle. So once partner A takes the motor vehicle, double entry is credit realization with the name of the partner, then come and debit the capital account. So once we are balancing off here, the credit side is still heavier than the debit side. So that means you're going to record 400 here and 400 this side. Now the difference, which is 400 minus this, is what you're going to pay out to this partner. And the difference is 191,050. So this is how much you're going to pay through the bank. Then we come to the second partner. We have 350 this side, and then 350 this side. So once you get 350 minus this, we are going to pay out 309,200 like this. Then now look at these two partners here. These two partners, they shouldn't have a balance carried down, because their accounts just dissolved. So it means that this side we have 135,500, and this side we have 135,500. So that means there is this partner won't take anything from the partnership, and then this partner also has 95,500, then 95,500. So they won't take anything from the partnership. So that is the capital account, and then the other is the relation account. So allow me to rub off this, then we come back with the bank account, and then we wind up with our question. Alright, so we are going to our bank account, and this is how our bank account looks like. Now, everything that we had to credit under realization, we are going to debit it here, like we said. So we are going to start with the balance brought forward. So our balance brought forward was 30,000. Now this balance brought forward is what we have in our balance sheet as the bank amount. Then we're supposed to bring our values as they were realized. So the very first thing was, if you check work, plant and machinery, so we're going to say realization. So you start with our plant and machinery, which was realized at 170,000. And then we're supposed to look at equipment, which was 260,000. And then we also have inventory of 80,000. And then also we have accounts receivable of 70,000. That's what we have as accounts receivable. Now, if you recall very well, one of the partners brought in money, partner C. He was contributing part of his deficiency. So we come here and we say capital. Just like in the capital account, we have to credit the partner's capital account in the name of bank. So we come here and say capital, partner C. So it was 17,750. That was his deficiency. Then we come on this side, we had the solution expenses. Or they are called relation expenses. And then they were 30,000. Then also bring in our accounts payable. Now our accounts payable, remember, it was 100,000. We had to take off that discount, which was 2,500. So meaning the 97,500 is how much we're supposed to pay to the bank. Then after that, we can bring in our capital accounts, where we had A and B. So A had 1,910,50, and then B had 309,200. That's what we had. Now, once we add up these two, the debit side, you're going to get 627,750, and then you're going to have 627,750. Now, like I said, at the end, this bank account should dissolve itself. The debit side of the bank account should be equal to the credit side of the bank account. So by us doing this, we are done with our number concerning partners who are insolvent. Thank you so much for watching. This is Kevin Davis Accounting. Subscribe to the channel, share to your friends, let them have a benefit. Until we meet again, it's a bye for now.